Happy Monday, Amera First, and good morning to Amera Trust on the West Coast. Buenos dias, Amera Uno, and it is seems like forever since we last were with you. Had a great week at Chairman's Club. More information on all that to talk about in the future. But today we have a very special friend and partner and guest, Barry Habib. You see him here. You see him on MBS Highway all over the world. He is the guy, the man, the myth, the legend. Lots of questions. We want to get right to it. No big formal introductions. You all know him. Put your questions down at the bottom. We'll get to as many as we can, but we do have a hard stop at 2:30 Eastern time. So welcome, Barry. How are you, my friend?
I'm great. We've got so much going on. I think we should try and just unpack it. One of the big buzzwords that we're hearing more and more is inflation. And inflation is what drives interest rates. I know that a lot of people can easily be confused as to what really drives interest rates. So let's take a look at this for a minute here and talk about inflation. So the best way I think to explain this is, for a minute, if all of you would just take some notes here, because I think this is critical. So let's focus together. So what is inflation? Inflation is too many dollars chasing too few goods. You see that every day in what's going on in real estate right now. There's simply too many buyers, which have dollars. So too many dollars chasing too few homes in inventory or too little goods. And that's bidding prices higher. And it's causing inflation in the housing market. So you get an idea of what happens when there's too many dollars chasing too few goods. Well, we're seeing inflation in the US, and it's coming from a lot of different areas. It's coming from the fact that oil is now much more difficult to get here at a more reasonable price. I don't have to tell you what's going on when you go to the gas station. And then food prices are going up and so many things. So we're seeing inflation in the United States at levels that we haven't seen before. We're going to get an inflation report this week called the Consumer Price Index. We're going to get that on Thursday. And the current year-over-year inflation is 7.5%, but I anticipate that moves closer to around 8% on Thursday on a year-over-year basis. Now, we haven't seen levels like that in many decades. So why is this so important, and how does it affect interest rates? So let's for a minute imagine that you have a fund, and that fund that you have, what you do is you go ahead and you do mortgages out of that fund, and you lend people mortgages out of your fund. So you give me a mortgage and I make a payment to you every month, and that payment's $2,000 a month. Well, you take that $2,000 and every month you get it and you go out and you buy a shopping list of goods and services, and you get everything on the list this month, and then next month the same. But over time, you realize that I can't get everything on that list. And why? Because inflation is causing the price of each of those items to go up. So I have to leave a few things off. So what's really happening is, while you still get a check every month and the check says $2,000, it doesn't do what $2,000 used to do. It doesn't go as far. The value, the buying power is eroding over time due to inflation. Now, you're smart, and when you loan that money out, you knew that was going to happen. So you charged me an interest rate that would take that into consideration. But if inflation starts to rise dramatically, like we've seen, well, then you can't do anything about the loan you gave me. But on the future loans that you're going to do, you have to think about that. You contemplate it and you say, well, I'm going to have my buying power eroding more rapidly. The only defense mechanism I have is to charge a higher interest rate. So I am at a higher perch to offset the more rapid rate of erosion. And that's why when inflation goes up, interest rates go up. On our last call, I went over this with you guys, and I told you higher rates was coming because I told you that in our last call, if you remember, we talked about inflation was going to move up because we saw that on the horizon. Part of that is because when you look at inflation, it looks at the last 12 months, and it gives you the year over year. So as you go into the new months, you're going to get rid of the now oldest month, and now you have 12 months to evaluate. Well, we knew that the new inflation numbers that were coming were going to replace very low inflation numbers, so we saw it rising. And if you remember, we told you that rates weren't going to stay below 3%. We didn't see that. We saw rates going up. I know a lot of people didn't really believe us, but here we are. Now, if we understand that when inflation is low, interest rates can stay low, but as inflation rises, interest rates go up, then this is what's happening right now in the marketplace. Now, how do we fight inflation? Well, you fight inflation by, remember, what is inflation? Too many dollars chasing too few goods. So you need to slow down the dollars or remove some of the dollars from the system. How does the Federal Reserve do that? The only way that they can do that is by increasing interest rates. You heard me right. They have to increase interest rates to slow things down. Why does that slow things down? Well, because it's more expensive to buy a car if you do that. It's more expensive for businesses to borrow money and commercial loans. So if I want to expand my business, acquire a business, these are all going to be dependent on interest rates that when the Fed moves higher, these rates move higher. And since it becomes more expensive, you might evaluate it and say, well, it's not worth me doing. It's too expensive. The cost doesn't justify the reward. So therefore, I won't do it. And that slows down the amount of buyers, which then brings down inflation. Interestingly enough, when inflation comes down, what have we learned? What happens to mortgage rates? They actually decline. So I got some slides here to show you. So let's take a look together and let's review. So the Russia-Ukraine situation causes problems because Russia is a very large exporter in oil. And also now what we have problems with US companies boycotting Russia, rightfully so, sanctions being placed, rightfully so, but these limit the trade that's existing in the world. So it makes things more expensive, which adds to inflation. Ukraine is the breadbasket of Europe. They're the largest producer of barley, one of the largest producers of wheat, things like eggs. They're very big producers of things you need every day to survive, to eat. But they're also really big in different metals, some of the largest production in all of Europe. They also produce something that's very interesting, neon gas. Now you might say, okay, well, neon gas, we kind of outgrew neon signs, right? So, but it's not just for neon signs. Neon gas is one of the critical components that goes into semiconductor production. And as you probably already are feeling, it takes a long time to get a car. It takes a long time to get goods. There's shelves in electronic stores that are barren because we can't get semiconductors. In fact, builders can't deliver homes in many cases because the appliances require semiconductors, and the homes are actually authorized, but they can't be completed because we can't get the appliances in the home to deliver the home. So this could become even worse. And then heaven forbid, we have a situation between China and Taiwan, where Taiwan supplies most of the world's semiconductors that causes even greater constraints. So as you can see, we're not left with a lot of good choices here. So we have to muddle through this situation. But while that's pushing inflation numbers a little bit higher, there are things on the other end that we need to consider. The Fed, as I mentioned, they're going to play a major role. And now the Fed can hike interest rates to slow things down, but they have another thing that they can do. And this one's a little bit more treacherous, and that is their balance sheet. Their balance sheet has about $9 trillion on it. They've been buying treasuries and they've been buying mortgage-backed securities. Now, the mortgage bonds that they're holding amount to around $3 trillion. It's a moving target. But what typically would occur is with mortgages is they would mature. In other words, people would pay them off. People would sell their home and pay off their mortgage. People would refinance and pay off their mortgage. Or every month there's principal that's a portion of the monthly payment that the Fed's receiving, which would normally reduce the balance. Now, they're not reducing the balance. They're taking that amount of money and reinvesting it in buying mortgage-backed securities. That comes out to $70 billion a month, and it's really helping to keep mortgage rates low. So let's keep that in mind. So the Fed is still being very active. And on top of that, they've been buying mortgage bonds, and that can help keep mortgage rates low. So they're buying $40 billion a month. Now they started reducing that this month. And by the end of next month, they should be stopping those purchases of mortgage bonds. And really, they should be doing this to begin with right away. So they're actually kind of stimulating and causing more inflation by buying these mortgage bonds, these new mortgage bonds. They talk tough and they talk about, oh, we got to fight inflation. But meanwhile, they're like an arsonist that's going to turn firefighter. Listen, if I said to you, what I need to do is I really need to think about losing some weight. So I'm going to circle May 1st on the calendar and go on a diet May 1st. But between now and then, I'm going to do everything I can to put on 15 more pounds and binge eat everything I can. I mean, that just doesn't, it's no logic to that. Maybe an individual might make that mistake, but the people who run the Federal Reserve, they shouldn't be making foolish mistakes like that. And yet that's what they're doing. That's because these 19 members who are charged with the most important pricing in the world, and that's the price of money, most of them have never so much as had a lemonade stand or a newspaper route. So they live in the world of theory. And this is why we have these boom and bust cycles. It's Fed induced. Now, we know that they could hike rates here and they could start hiking rates. And let's hope they do on the 16th of this month. They should hike rates, but they've already started to lose their resolve. They should have gone with a 0.5%, 50 basis point hike on March 16th, but they've already backed off of that. They say, well, now we'll only do a 1/4 point. So they're sending mixed signals here. They're not really showing that they want to fight inflation. And on that news, when the Fed said, we're not going to do 50 basis points, we're going to only do 25, so less of a rate hike, mortgage rates went up 1/8% on that day. So you can see here that the point we're trying to make is most people think when the Fed hike rates, mortgage rates will go up. It's the opposite, because if the Fed fights inflation, mortgage rates go down. The balance sheet, however, that is bad. If the Fed starts unloading mortgage bonds or allowing mortgage bonds to run off their balance sheet, interest rates don't like that. And that's why there's two things that the Fed can do. One, hiking rates will be good for mortgage rates. Two, allowing the balance sheet to run off or even selling mortgage-backed securities, that would be bad for interest rates. So that's the key point here. The Fed should hike sooner, but they had no backbone. Now they've left themselves with no good choices. They thought inflation was transitory. A bad mistake. Jerome Powell blew it. The Fed blew it. It wasn't transitory. It's very sticky, but they screwed up. They've watched inflation go from 1.5 to now 7.5 and probably 8% by the time we get the report Thursday. So history is a great guide for us. And Mark Twain said that history doesn't always repeat itself, but it tends to rhyme. And I really think that's true. So let's turn the clock back. Let's go back to the 70s, the late 70s. Let's put on your disco shoes here. And now our Fed chair back then was this guy, Arthur Burns. And he looks kind of smug. And he was, because he thought, get this, he thought inflation was, do you believe he used the same words? Transitory. But he was wrong. He watched inflation go from 7% to 14% in 2 years. And that caused a lot of pain, because now it was costing people a lot more, just kind of like it is now, a lot more to buy the goods and services you need at a faster pace than your income can keep up with. So what happens to your standard of living? Your standard of living was getting worse. It's decreasing. Nobody likes that. So he didn't do anything about it. And because inflation rose so much, well, what have we learned? What happens to mortgage rates when inflation goes up? Well, mortgage rates go up, remember? And they did. Mortgage rates went from 12% to 18% in those 2 years. Could you imagine that type of a rise? 6% increase in mortgage rates. And you talk to somebody today and tell them a rate of 4%. They're like, oh my God, that's high. Well, this is relatively speaking, still pretty good. Now, he didn't do anything about it, but under Ronald Reagan, Paul Volcker comes in as Fed chair. And I've had a chance to spend some time with him. Amazing man. He's been called our greatest Fed chair because he had backbone. And he was tough. And he said, I'm going to kill inflation. And he did by hiking rates. The Fed funds rate was 11%. He took it from 11 to 20% in 2 years. See how the Fed is like worried right now? Our Fed funds rate 0. And they were, oh, they'll raise it 1/4, raise it 1/2. And he was taking it up 2% at a pop. And by doing so, he made the cost of borrowing very expensive. Business contracted, things slowed down, less dollars chasing goods, less inflation. He slayed the inflation genie, but he did so with some consequences that I'll explain to you. Now, inflation dropped from 14% all the way down to 5%. And because of that, what have we learned? When inflation drops, mortgage rates drop from 18 to 12. So what happened here? He raised the Fed funds rate 9%, 900 basis points. And yet because inflation dropped, because he was successful in bringing down inflation, that's the key point in the middle, mortgage rates dropped from 18 to 12. But it was not without consequences. The stock market got hammered because stocks don't like it. And we went into a recession. You should know that every time our central bank, and since 1913, that's been called the Fed, has tried to fight inflation by tightening monetary policy, like hiking interest rates, we have gone into a recession every single time. So let's fast forward 20 years, and you've got our man, Alan Greenspan, is at the helm of the Fed. And he watched inflation go up from 1.75 to 3.5, but he didn't want to be like Arthur Burns. He watched mortgage rates go from 7 to 8.5%. He said, you know what? I am going to take action swiftly. I'm not going to let it get out of hand. And he started hiking rates by almost 2% in a year. And as a result, the economy slowed down and inflation slowed down. And because inflation went from 3.5 to 1, what do you think happened to mortgage rates? Well, what have we learned? Mortgage rates declined. So he hikes rates and mortgage rates declined because inflation dropped. And this sparked a big housing boom. It sparked a big refi boom. But you know who didn't like it? The stock market dropped 50%. And again, we went into a recession. So let's go another 20 years. Seems like this happens generationally. Every 20 years, the same mistakes. And our man here, Jerome Powell, which I've spoken to, and this guy is obviously a bright guy, but he screwed up on this one. He thought that inflation was transitory. He watched it go from 1.5 to 7.5, now maybe 8%. And we've seen mortgage rates rise from 2.5 to about 4%. And they probably would have gone up more if not for all the Fed buying of mortgage-backed securities. Now, they can still rise a little bit and inflation can still rise, but I think there's a possibility that we see inflation start to crest here and maybe level off, maybe even drop a little bit if the Fed starts hiking rates. But this new situation with this enormous rise in oil prices is going to filter its way into inflation numbers, and we might see inflation be a little bit stubborn and sticky here. But if the Fed can tame inflation, what we've learned is that mortgage rates should drop. Now, let's recap this and let's see if you can have some great pattern recognition. Now, pattern recognition is really important, folks. It's important for us from a survival standpoint. We all have the ability to do pattern recognition because we need that to survive. But if you want to excel and be super successful, you need to hone your skills in pattern recognition so you can anticipate what's about to happen. So Arthur Burns was the Fed chair, saw inflation go from 7 to 14, did nothing, thought it was transitory. So mortgage rates rose from 12 to 18%. Then Paul Volcker comes in real tough, hikes the Fed funds rate from 11 to 20, slows the economy, inflation drops, and mortgage rates drop. So hike and mortgage rates drop because he caused inflation to drop. S&P didn't like it. We go into recession. Greenspan, inflation rises, he sees mortgage rates rise. He acts quickly to slow things down and hike rates. Inflation slows down and mortgage rates drop a lot. So hikes rates, mortgage rates drop because inflation drops. So that's the important component. Hike and mortgage rates drop, but only when you see the inflation drop. S&P didn't like it, cut in half, recession. Jerome Powell, asleep at the wheel, watches inflation dramatically rise, mortgage rates rise, says he's going to bring rates to 1%. Let's see if he does it. As a result, the economy should slow, mortgage rates should follow inflation because inflation should drop and mortgage rates should drop. But we put this out initially. We said, hey, the stock market looks vulnerable to us. It's down significantly since then. You know what's happened. So we kind of called that one. And recession looks to us to be in the cards. So we see recession coming probably end of this year, next year. And I'll show you some reasons why. But first, let's take a look at the last time we saw a similar setup. So when was the last time the Fed started hiking rates like they're about to do on March 16th? They wanted to do so to fight inflation. And when the Fed hiked rates, we're looking at the 10-year Treasury yield. This is like a proxy for mortgage rates. They hike rates here and boom, mortgage rates go down. Now they don't hike rates for a while. So inflation creeps in and rates go up until when? Till the day they hike again and boom, rates go down. And while they zigzag here, the trajectory is lower. Nothing's going to move in a straight line, just like here, zigzag, but the trajectory lower until they do what? And this is why it's so important. Remember I talked to you about that balance sheet. Well, the Fed started to allow their balance sheet to run off at the same time they were hiking rates. This is like a mad scientist. Usually when you do an experiment, you wanted to introduce one variable at a time and see what it does. But the Fed did a 2-variable experiment by both hiking rates and letting their balance sheet run off. As a result, mortgage rates, once the Fed started to run off the balance sheet, almost from the day it was announced, started going up. Until what day? When they slowed the pace of their balance sheet runoff. And when they stopped the runoff of their balance sheet, wow, we really dropped. So you can see here that we are very much going to be dependent on what happens on how the Fed handles the balance sheet. If they were smart, they would just hike rates, maybe for a year, maybe do a quarter at each of the 8 Fed meetings during the year, get that Fed funds rate to 2%, and then say, let's see, but let's leave the Fed's balance sheet intact. We won't buy anymore, but let's hold on to that. That's what I would do if I were Fed chair, but I'm not the Fed chair. So who knows? This is the drop from COVID here, but you can see how important that Fed's balance sheet would be to interest rates on mortgages. Now, there's a lot of talk. In fact, it was the most searched term on CNBC today, and that is the yield spread. The yield spread between the 10-year Treasury yield and the 2-year Treasury yield. So the 10-year Treasury yield, whatever the interest rate you get if you invest in 10-year, should be higher than the 2-year. Think about it. If you're going to put your money away for 10 years, you expect to get a better return than if you're only tying your money up for 2 years. That's natural. And it's like that the vast majority of times. But on occasion, what you get for putting your money away for only locking it up for 2 years, It's higher than the 10-year. Why? Well, the 10-year yield is more dependent on what? Inflation. When inflation's lower, there's less money, the economy's slowing down, and lower inflation means that 10-year trades lower. But the 2-year treasury, that's more concerned with the Fed. The Fed's overnight lending rate is a 1-day lending rate. They could change it overnight. So when the Fed pushes rates up from the bottom, things like the 2-year or 3-month or 1-year, they all get levitated. They get pushed up from the floor, so they go up. 10 years coming down, that 2 years going up. What's that telling you? It's telling you that the Fed is too aggressive and pushing rates up too much, and the economy is slowing down too quickly. You get that inversion. And you could see here, this is the normal state when it's the 10 years above the 2-year, but in periods of time when you get that inversion, it's illustrated in red. The gray areas are recessions. So you could see here in the 70s, when the Fed did this, we had a recession. In the 80s, when they did it, we had a recession after they did it. In the late 80s, early 90s, when the Fed did this, and you get the yield spread inverted, we had a recession. 2000, recession after inversion. Inversion, recession. Most recently, inversion, recession. Now, if you take a look at where we are currently, and you could see the trajectory here, we have been heading low and getting close to an inversion. How close? Let me show you. If you looked a year ago, the 10-year treasury was about 1% higher, 1.6% higher than the 2-year. Back in October, it dropped to 1.3. At the beginning of the year, it was 0.9. At the beginning of February, it was 0.6. Just last week, it was 0.37, but today, as right now, live and in real time, it's 0.24. So you could see the trajectory. We're headed for an inverted yield curve, which 6 to 9 months from inversion, pretty good guess that you'll be near or at a recessionary time. So is that terrible to have a recession? Well, what happens during recessions? Well, interest rates are low, big refinance opportunity. And believe it or not, real estate goes up. But before we do, let's think about the strategies here. Now, you guys remember how we talked about this together back in 2018 and 2019. I remember coming to Kalamazoo and talking with you guys in 2019 and forecasting and predicting the recession. And we were right. When we forecasted that for you, and I think that was March of 2019, that it was about to happen within the next year, and it happened 10 months later, we looked at all these same things. And the advice I gave you, I pulled up that presentation. The advice I gave you was, don't pay upfront MI, pay monthly MI. Don't pay points, pay 0 points. And don't look for the lowest rate. Exchange that lowest rate for a rate that has a higher rate, but with much lower fees. And the reason for all that is because we believed that you were going to be refinancing those loans. If they didn't move, they'd refinance within the next 2 years. And of course, that was great advice to give your customers. We see a similar circumstance here. We see recession-like conditions. We see lower interest rates than what we have now. It's shakier, it's rockier, it's less clear because of Russia, Ukraine, because of supply chain, because we've got a lot of things on the oil side that might make inflation a little bit more persistent. But over time, we see recession-like conditions, a lot of debt, lower interest rates appear to be on the horizon, although it may take some time to get there. Now, what about housing? What about real estate? Well, here's what the interesting part is that home values tend to do very well during recessionary conditions. It happened in the 50s and 60s. It happened in the 70s. These are home prices. They go up during recessions, up a lot in the 80s, up a lot in the 90s, up a lot in 2000. Now, here's the exception. But it wasn't that like a recession caused the housing bubble. This is the housing bubble here. The housing bubble led us into recessions. You know, think about it. What were those loans like? Nothing down, 580 FICO, no income, no asset. I mean, heck, what could go wrong with those loans, right? Well, when that bubble came to roost, you see what transpired here. The most recent recession, well, home values went up a lot and have continued to do so. So don't worry about a recession. You know, the media always gets it wrong. And I know we only got 5 or 6 minutes here, so I'll go quick. But if you look at the history of how bad the media has been, our friend Diana Olick here in 2015, she goes, it's a bubble bigger than 2006, but home values went up about 5%. And then she says in 2006, a new housing bubble, but home values went up again. And then she said, home ownership doesn't build wealth. Well, obviously, there's been a lot of wealth created for pretty much everybody who owns a home since 2017. So then in 2018, she says, better to rent than to buy a home. Well, you show me the one person who was better off renting. Nobody was. And then 2019, housing market's about to shift in a bad way. Well, really? Home values did nothing but go up. And then in 2019, their forecast for 2020, it's going to be hard on the housing market. It was only hard if you didn't buy a home, because 2020 was a great year. And then 7 months ago, she goes, the housing boom, it's over. It's over. Since then, home values have gone up 11%. If you were thinking about buying, let's call it a $500,000 home, and listen to Diana Olick, you would have lost $55,000. So now let's take a look at demographics, because demographics is destiny. By the way, I've shown you guys this chart again. The reason we use it is because it's super accurate. Today's first-time home buyer, according to Zillow, the average age is 33 years old. They were born right here between 1988 and 1989. Now, what you'll notice here is that this year's crop of first-time home buyers is larger than last year's by a lot, but not as big as it will be next year or the year after or the next few years. In fact, into the foreseeable future, it's more than last year's, and definitely going to be in a position where it puts more buying demand in place than we've been experiencing. Now, we use the same chart to correctly identify and forecast the housing bubble. So the housing bubble occurred, as you remember, it began in 2006. So how old was that first-time home buyer? They were 33 years old in 2006, which means they were born here in 1973. Now, the birth rates dropped dramatically. There was a reason for that. The birth rates dropped because of the legalization of abortions. Naturally, births declined and stayed low for a while before recovering. But if we fast forward 33 years, you could see huge drop in 1973, which means there should be less households formed 33 years later in 2006, stay low for a while, and then pick up. Well, let's see. Yeah, exactly. Hand in glove. Big drop in births, especially in 2006, 33 years later, stay low, and then they start to pick up afterwards. It's got to be that way. Look at it again. Here, big drop, stays low, picks up. It's got to be that way. Why? Well, because these people were born, they're coming. It's a hand in glove fit. What do we know about the future? We know that demand is going to increase based upon what? Based upon this here. That's reflected here. Now, these gold bars show you builders putting up homes, and builders putting up homes is the supply side. So it's normal for builders to put about 100,000 more homes than the amount of demand, because you get about 100,000 homes a year that are destroyed or renovated or rebuilt or whatever. But in 2006, you had that big drop 33 years after birth started to decline, but builders didn't get the memo. They put up more homes than ever, and that started the imbalance. 2007 exacerbated it. In 2008, you had a whole full-blown housing bubble. But today, you've got the exact opposite. For somebody who says, oh, you know what? This feels a lot like a housing bubble because prices went up. No, it is the exact opposite. It's a housing boom, not bubble. And the future, how are builders going to keep up with chips, supply chain, labor shortages, regulate? Not easy. Okay. Now, rates go up, demand will slow for sure. But what's their alternative? Rents are going up at 19% a year. Purchase activity, well, it's at a record high, even with interest rates 1% higher, even with appreciation 19 or 18% higher. And inventory from 7 months ago is down 34%. From a year ago, it's down 14%. And we're still at record high purchases. Look, if you want to look at 2007, compare it correctly. There were 3.7 million units for sale. Today there's 860,000 units for sale. And you could see the inventory declining. You could see this decline year over year. The seasonal rolls. And here we are at 860,000 units. This is a very big problem because there's no inventory, as those of you are experiencing when you're looking at the inventory that's out there. And back in 2007, everybody lived under 116 million household roofs. Today, it's closer to 128 million. So what does that mean? 12 million more households, but 3 million fewer homes to buy. Now, when we take a look at people saying, hey, we're 41% above the peak in 2006 of home values, we got to be in a bubble, right? Well, not really, because back then interest rates were 7. Today, they're half that. And people were making $20 an hour on average, according to the Bureau of Labor Statistics. Now they're making 32. If you wrap a bow around this, if you bought a home in 2006 with a $300,000 mortgage at 7%, your monthly payment's $1,996. Today, a $423,000 mortgage, 4% rate, it's $2,019. Let's look, $2,000, $2,000. It's not the difference here, $23 a month. The difference is you're making a lot more money. Even though you have to take out a $423,000 mortgage to account for the 41% appreciation, your income more than handles that, because back then, if you had two income earners earning $3,000 a month apiece, you're making $6,000 a month. Today, you're making, based upon the increase from the Bureau of Labor Statistics, according to the last 16 years, you're making $9,600. So your front ratio back then was 33. Today, it's much more affordable and easy to pay at a 21 front ratio, even though it's $123,000 more you're borrowing. Our forecast is for rents to keep going up by more than 5% a year. So that's no picnic. They've gone up 18% in the last year. We see mid single digits. We see 8.5% home price appreciation in the next year. So if it's a $500,000 home, that's $40,000 to $45,000 in appreciation. Don't miss the boat. Craig, I'll turn it right back over to you, brother.
Yeah, thank you so much. We do have a question in for Brian Maddox, but as always, you've already answered both of his questions. So I think we're good there. But we have a number of certified mortgage advisors. I know that's a program that's near and dear to your heart. You created it. We've got a number of them here at AmeriFirst, but I wanted to give you, we've hired about 75 or 80 LOs probably since the last time you've joined us. Share a little bit about what that means, how they might be able to look into that. And I know that wasn't it's not why you're here. You didn't even ask for me to do it, but I think it's really important because today more than ever, for people to be educated and understand what's going on in the market, we can become truly advisors.
So, there's a couple of things that come to mind. It's been said that the two most important days in your life are the day you were born and the day you found out why. And if what you're doing is a job, that's one thing. But if what you're doing is a career and you want to realize the responsibility that you have with the largest financial transaction that people make in their lives and actually changing lives and advising them correctly, then you really need to be doing this. You either have to decide, are you a salesperson or an advisor? And the way I like it better to look at it is you have to decide if you're going to be a chess piece or a chess player. A chess piece, you're going to be moved around by the market or whatever the conditions are or whatever the wind blows or whatever others decide. But if you're a chess player, you're going to dictate things. And in 2022, while information is everywhere, wisdom is a very, very, very valuable commodity. We know that refis are down 56%, but it doesn't have to be, because if you're using debt consol and the debt consolidation tool in MBS Highway and understanding how to impact that and create wealth for people, your refis should be up, not down. And I'm talking about taking people from 3% and putting them to 4%, but doing it smart. And then if you're looking at understanding the markets and helping to advise people why they should bid over ask, if you want to understand what the Fed means, all the stuff we talked about, if you don't want to just listen to it, but if you want to actually understand and teach it, you need to be on top of your game more than ever right now. Every time in life that you come across an obstacle, there are things in life that we hate, right? Hate losing a job, hate making a change. I got my heart broken and I hated it. I cried. It was awful. But guess what happened? If that didn't occur, I would have never found this amazing situation I'm in. I would have never found this person that I'm with now if I didn't get my heart broken. I would have never found this amazing job that I'm in right now and doing what I'm doing if I didn't lose the last. I hated it when it happened. And if you understand that change, and depending on how you respond to it and look at it, can give you enormous opportunity, then if you understand that, then having that CMA designation, really understanding the markets, being a chess player instead of a chess piece, that can allow you to take these adversarial times and turn them and create them into opportunities to continue to grow and really optimize and take advantage of the next step. So yeah, I'd advise you to do that wholeheartedly.
All right. And you can reach out to Consider It Done at AmeriFirst.com, and we'll get you all the information on the CMA program and MBS Highway. So again, Barry, as always, a lot of information thrown in a short period of time. Really, really, truly appreciate your friendship, your partnership. And thank you again for being with us today.
Well, I love you guys, man. God bless you guys. I love you guys. Be well.
Thank you. You as well. All right. We'll see everybody on the readiness call Wednesday at 11 o'clock Eastern. Until then, Be smart, be safe, and have a great rest of your day. Take care, everybody.